Well, welcome to our session about disrupting the banks, or otherwise stated, innovation in the financial services sector. Welcome, panelists, Markus, Christian, and Jeff. Can each of you briefly introduce yourselves and the businesses that you are active in? Markus.
Hello, ladies and gentlemen. My name is Markus Braun. I'm since 14 years the CEO of Wirecard. Wirecard is a first-generation internet company in the area of online payment processing. We can say today we are the largest online payment processor in Europe. And I think when we come shortly to fintech, I think what Wirecard did, combining internet technology with banking services in the area of payment, is exactly what the idea of fintech is about. And this is probably why we're today here invited. So thank you for the invitation.
Great. Yeah. Christian.
Hello as well. I'm running my own family office, investing mainly in Germany. Did a lot in Africa, which I sold. Will someone hopefully do something again there? I did a lot of financial services over the last 16 years, so very traditional businesses. I do a lot of tech, hence fintech as the merger of those two sectors is one of my main focuses.
Hello, I'm Jeff Stewart, founder of Lendo. And we use algorithms and machine learning to help financial institutions extend credit, especially in the emerging market.
Fantastic. So here comes the first question, and it's a question that we think about a lot when investing in new companies, and that's the question of why now? So the internet has been around for a long time, mobile phones have been around for a long time. Why is it only now that we are talking about disrupt the banks, and not 5 years ago or 10 years ago? So there's P2P platforms who do P2P lending, there's algorithmic companies who are going after the market. Why is it that we're talking about it now?
Well, I think the big change is the mobile phone. You know, this phone is essentially with you all the time. It knows all about you. And that data can be used to eliminate fraud. That data can be used to figure out what's the right service for you. And it can be used for risk management. And it can be used to radically change the cost structure and customer expectation. So I think one of the big reasons that the banking industry is about to be disrupted is because of the mobile phone. The second is the cloud. The ability to use machine learning to deal with these massive data sets is really quite new, and that's going to change financial services. And then the third is the cost to move money. It's becoming decimalized, pennies, where it used to cost dollars, and it's becoming real time. And that means that you can now have competitors from anywhere in the world, as opposed to just the bank down the street. So I think these three things are coming together to radically change financial services.
I would like to add something. I think it's absolutely true. I think the smartphone is a big leverage for fintech. But I would also add some soft thing. The first thing where people must get trust online is, for example, purchasing a good. And I think this was the development of the last 10 years. Today, people trust to buy, I don't know, airline tickets, to buy consumer electronics online. And I think banking services have to build on such trust. If banking, or if we would have tried already 10 years ago to bring fintech business models to the street, I think it would be a tough sell, because I think for banking products, there already has to be built a trust around the paradigm. And I think this is today there, together with the technologies, that really from the mindset people start to be open, also to take at least some banking services over their smartphone, over online, etc. And on this, I think fintech business models can definitely leverage. Beside of course, a lot of technology that is not there, NFC, smartphone technology, host card emulation technology. But I think it's also this lifestyle factor. So I think it's exactly the right timing. And you always need both. You need the right mindset and the lifestyle, and you need the technology.
Christian, you want to
But
say something?
as a compliment, by the way, for Wirecard, I would add that the word is existing now since some years, and it's becoming like a little bit of a trend or a hype or whatever. But I think there are fintech companies around since a way longer time. Yeah, take, for example, all the online brokers, like E-Trade disrupted in America, or like a FedEx or Consors in Germany. Yeah, they disrupted the equities trading market. Yeah, Wirecard is around since a long time and disrupted the payments market. So there are tech companies around, or internet companies, who disrupted parts of the banking industry. Yeah, just the word fintech was not around then 10 years ago, 12 years ago. And it's now becoming more of them because of the reasons they said. But I want to say the sector itself, without being named in that way, is around for longer.
Yeah. I would also add that after the financial crisis of 08, 07, of course, the banks withdrew from certain areas, which gave opportunities for new companies as well. So today, if you were a bank, hey, how seriously would you take this risk? Because these are massive businesses, massive markets, and startups are just nibbling at like tiny little corners of this opportunity. Yeah. If you were a bank, how seriously do you have to take this?
First of all, I would say I wouldn't take it as a risk, but as a super large opportunity. I think that many banks are in a process of transforming their business models, and I think online internet technology in all sales channels, call it fintech, call it technology transformation, is also a big chance, especially for retail banks, to transform their processes, to become cool again, to, let's say, perfectly adapt to this opportunity. So if I would be a retail bank, I wouldn't see it as a risk, but as a super large opportunity. And I would heavily start to invest in this area.
The same here. I mean, I think that it's at least equally a big chance for existing banks than it is for startups. So for example, if we take the B2C fintech sector, a lot of companies I see, I would say, will not be successful. Yeah, because my theory is a little bit in the B2C model now, in the retail model, that the clients have almost like a Stockholm syndrome. Yeah, everybody is saying he's unhappy with his bank, but then if you look at the numbers, how many people really do change from traditional financial services providers to B2C fintech companies, it's so little that the customer acquisition costs are very high, and this really burdens and sometimes makes new business models very hard. So I see a bigger chance for existing pools of, let's say, pools of clients, pools of business, to digitalize it, yeah, and to use technology, but onto existing clients, yeah, than to start a new business. Yeah. So it's a big chance for existing banks. So you will see actually more banks eating other banks. So you will see the dumb ones who don't get the change, but their business will be taken over more by the smart, technologized banks, not so much, I think, especially in the B2C sector, by newly created startups.
Because the technology is social and it's mobile and it's real time, services can get very big very fast. So I think banks have to take it seriously. Snapchat added 100 million accounts in a few months. No bank has added that many accounts that fast. Tencent amassed $20 billion of deposits in a few months. So you know, when you combined your phone with a service, it really changes the way it's used, the way people think about it. And I think that the future of financial services is not, oh, this is my bank. It's, yeah, this is just how I get stuff done. It's part of my artificial intelligence. It's part of how I make decisions. It's part of how I live my life. And the banks we talk to, many of them are taking it extremely seriously. We worked with one of the top banks here in Europe, and I said, you know, we're working with your biggest competitor in Europe also. Are you okay with that? And he said, I'll compete with any bank in the world. I'm going to be competing with Tencent and Facebook and Alibaba in a couple of years, and I need to be prepared for that. And I think he's correct.
Yeah. Just let me add one thing. I think a retail store or a big fashion brand, etc., is also successful today, even if when they come from brick and mortar, if they fully adopt to these new paradigms and if they really try to implement it in their core strategy. And I think this is necessary there too. It's not enough just to, let's say, build up an fintech department inside a bank. But I think, of course, it would be a real transformation of the DNA towards a more internet and software-driven approach. I think that's definitely necessary. But if they do it, I think that also classical retail banks can see this whole area as a big opportunity. As internet as a whole is also a big opportunity for classical retail stores and for classical brick-and-mortar companies.
Correct. So now banks, of course, do many things, right? They take deposits, they lend, they issue credit cards, they do payment processing, they do money management, et cetera, et cetera. Many startups kind of tend to go after just one vertical slice of this whole set of offerings. So it's conceivable that we end up in a world where you go to, instead of just going to one bank, you end up going to startup company A for deposit taking, startup number B for lending, et cetera. Do you think that is a customer proposition that is attractive? And do you think that you can actually make money as a bank or a startup in just one particular sliver? Or is the fact that banks offer everything a result of the fact that you actually have to provide a bundle?
I think, first of all, we have been discussing before that fintech is a large opportunity for banks. I think, of course, it is also a large opportunity for startups and for new ideas. I think that this creativity thing, where new young companies are coming in and are working together also with traditional banks in this area, this could be the real revolution. And this is really bringing, or this has been a very successful thing online, generally spoken. But if I would have a startup today, I would very much concentrate on the special slice or value chain element in this area. Might it be on the front-end side, really selling bank accounts over a new app, or really concentrate on a peer-to-peer lending process, and even in the value chain elements there, really concentrate on a certain core competence where I see the future. I think I definitely very early also have to find a real business model. I think it was one big mistake of many internet companies in the beginning, not at all focus on a business model, but giving out everything for free, and then over time to start to find a business model. Sometimes it was very successful, take Google. Sometimes it was not so successful. I think in the fintech area, it definitely makes sense for a young startup quite early to have a real understanding and a real vision how to make money in the future.
Christian?
Yeah, the same. I would add, I don't think it will be like the customers go for lending to this company, yeah, and for account management to this one, and for robo-advising to that one. I believe there will be like holders of like the ones who have the client relationship, and then they will add onto their platform like a robo-advisor, like a lending, or several lending opportunities. Like you see, for example, Interhyp, a successful mortgage company. So they provide a platform, and all the banks are using it, and so practically Commerzbank can offer mortgage loans from 10 other banks. Yeah, but still, Commerzbank is the holder of the client relationship. So, and I think, meaning I'm very much focusing on who will at the end own the customer, because he has the control, and I think it's pretty cheap then. It's super easy to make a robo-advisor. Yeah, that's nothing. I have never seen any sophisticated one. It's a nice idea. It's a nice idea if I provide it to millions of people, which I already have. Yeah, but I can't imagine how you stand alone make money on it.
Well, I think one thing that we learned from the media industry is that there'll be players who have radically different cost structures and will offer services just to be part of, just to get the information about the transaction. You know, there's a saying that Craigslist turned a wonderful $4 billion industry into a $300 million company. And I think you're going to see that, you know, there'll be people like Samsung Pay or Google who will move your money around just to see how you're using your money so they can target ads better, or just so they can have a closer relationship with you. So I think that when you have digital services, you can take advantage of the fact that you don't have branches, you don't have 800-person compliance departments, you're not worried about Basel III requirements. And I predict that the financial services landscape is going to look very different in 10 years.
we should come to regulation. You should come to regulation then, because I think the reason why this won't happen in that sort, Google will not move money around unless it becomes a bank, and in the moment it becomes a bank, yeah, it will have 800 compliance people and all the problems, all the tasks, yeah, a bank has. So I think this is what we should touch, that the banking industry is regulated, yeah, I would say mainly for good reasons, yeah, especially, let's say, in these basic services, money transfer, we all think about terrorism, blah, blah. I think you don't want to have a Google moving money around for free, but yeah, not really knowing or not really complying to the usual business. And then they can't make it for free, or it's harder to make it for free if you have to comply with regulation.
We can jump to the role of the regulator. So typically regulation is associated with burdensome bureaucracy and something that holds back innovation for new startup companies. But of course, regulation in this industry is needed to protect consumers. But regulators in different geographies have played different roles and actually have been quite advanced in some of their thinking. So what is your opinion of the role that regulators have played in this whole new transition for this industry?
Well, at Lendo, we work with regulators all over the world, and generally, once they understand how we're helping people get access to financial services that in the past they wouldn't be able to have access to, they're very supportive, and in some cases, walk us into the other banks in the country. We have one case where a regulator is piloting using our algorithms as an alternative for knowing your client, KYC, AML, knowing your client, because when you administer that identity check through an algorithm, it radically changes the cost structure. And the regulators understand that. It means more people can have access to financial services. So I think that they're being proactive. They're watching this. But we're not taking deposits. Once, it's companies that take deposits are regulated very differently, and they should be. They're holding people's money. And I think that the deposit-taking regulators are being very cautious, and that's going to be a problem for banks who take deposits to innovate quickly, because they have to both move slowly and protect their deposits and move quickly to serve customers. We release software every day. Banks typically will release software a couple times a year. If you're offering a mobile service, you have to tweak it. You have to try what's the interface that works. You have to be, there's a new version of Android came out last night probably. You may need to change your software. That's not how traditional banks work. And that's probably a good thing that they don't move fast and, when they're holding your money. So I think they're in a tricky situation to separate this. And the regulators are aware of that and trying to figure out how to solve that.
Coming to this, or adding to this difficult regulation question, I would like to answer this twofold. I would like to answer it out of an entrepreneurial point of view. And here I say, if you set up today a business model in the fintech area, you have to comply with the national bank regulation law that is there. It doesn't make sense to have, let's say, some hope that this changes, but you really have to set up a business model that complies. We know that some internet business models came up with some, let's say, challenging regulation in other areas, take data protection law, or take something like Uber that is challenging many national regulations. But in banking, that's a very tough approach. So I wouldn't recommend that. Yeah. On this level, of course, it's the same for every investor or for every business model, because everybody has to comply. So from an entrepreneurial point of view, it's a level playing field. If I give you an answer how I see global developments, and if I compare Europe, Asia, etc., I'm quite optimistic, especially in Europe. We saw a lot of paradigms coming up in regulation that made it, at least in payment and in some fintech areas, more easy to work in a consistent way on a European-wide basis. Take, for example, the fact that when you have a bank license, it can be passported in all of Europe. That's a very good paradigm. We very often forget it. We're always bashing regulators, but this is a very good thing in Europe, that we can consistently work there, which is not there if I take many tax regulations. If I take, for example, value-added tax, which is still national. So on the other side, if I look internationally, of course, in Asia, you have a country-per-country approach. And I would say there is, beside of regulation, there's always a second element. Of course, when it comes to banking and financial services, in many countries, you find, for good or not good reasons, I do not want to judge that, but it's a fact, of course, you find protectionistic elements. So it starts with that as a non-local company, you can only own a certain share on a financial institution. I think on both levels, I see good movement into a more liberal way, and I see an adoption of internet paradigms that also make it possible to act here on an entrepreneurial basis. So coming back, is there the right environment today for young companies also to invest in fintech? Yes, I think from a regular, it would just be an excuse always to put it on the regulator that it is not possible. I think it's possible.
So Christian, you have been investing around the world. But what are the forward-thinking regulators that you have encountered?
Well, I also have to agree, the European one is actually not bad. So they're actually all the rules, if you think them through as an entrepreneur, they make also sense. You might not like the burden, but they are pretty rational. So I've never encountered in Europe a very unrational rule. Yeah, take lending. Yeah, so all the restrictions on banks, what they can do with the retail money, are really like diversification rules you should do as a company anyway. Even if you were not regulated, you should apply the same rules. Don't put more than 25% of your equity in one credit, whatever. That's very rational. Yeah. So and then what Markus said, Europe is very, very advanced because we have a unified banking regulation. If you go to the US, actually, and always people say, oh, look at the Anglo-Saxon market, they have much more advanced. No, for a lot of sub-banking businesses like lending, you have to have a license in every state.
Yeah.
So
just as an example,
it's extremely painful.
Yeah, we are investors in a money transfer business, which is attempting to displace Western Union. So they transfer money from immigrants back home. And I'm on the board of the company, and I've been fingerprinted for 50 states now, and they all want to have paper fingerprints, 12 copies times 50. So it's a very outdated kind of.
So Europe is, I would say, actually Europe, and I mean continental Europe, because everybody's saying, oh, look at London there. Continental Europe, in terms of regulation, is never convenient, but in terms of pragmatic regulation is pretty advanced. Take Africa, you have 51 states and you have 51 regulations. And then often in emerging markets, people say, oh, the regulators are more easygoing. If I'm a little bit cynical, they are also more easygoing because they're not so advanced and not so understandable. So some businesses in Africa are not regulated in banking because the regulator has not the capacity. You just do it, yeah? But if they had the capacity, they would regulate it as well. So it's not because they want to be so easygoing, it's sometimes because of missing capacity. So Europe is really not that bad.
Yes.
I think the elephant in the room, is that an expression? Yeah. Is that the internet is inherently supranational, and financial services regulation is inherently national. And we saw it with media. Companies couldn't control where the message and how their content was distributed. You're going to see the same thing in financial services, where a lender in Singapore uses technology in South Africa and capital from California to lend to someone in Berlin. How do you regulate that? Which regulator is in charge of that? And it's going to, because companies like your money transfer company are bringing down the costs, it means that you can have competitors or new entrants from anywhere in the world. It's going to be very interesting to see how that gets dealt with.
On the international bit, so your business started in Latin America, right? So you have been investing a lot in Africa. So the opportunities for startup companies or banks in this new era, how do they differ per geography? Obviously, here we have a very European view on the opportunities. But tell me, what interesting services can be provided now in, say, in Latin America or Africa?
Well, the reason we were drawn to the emerging markets was hundreds of millions of people are moving into the middle class, and the traditional banking sector has a lot of trouble servicing them. They don't know who they are. They're not in a credit bureau. They're essentially a complete stranger to that bank. But if the consumer shares the information on their phone, we can know who they are. We can vouch for them that they are who they say they are, and we can understand the risk of doing business with them. As hundreds of millions of people move into the middle class in places like India and Brazil and Indonesia, they're going to need access to financial services, and the opportunity to change people's lives is so big. I mean, yes, we could be making it slightly less expensive to have a credit card in Europe. I mean, that's interesting. We'll do that. But what we're really drawn is the excitement of how do we get 1 billion people to have access to financial services. Today, there are people going to school who are able to pay for school because of loans that we facilitated. And we're changing people's lives. There's medicine. People's health is radically changed because they were able to get the medicine that they needed because of access to financial services. I think when we look 10 years from now, what did we accomplish? And we can say, here's 1 billion people who have better access to financial services. We're going to feel a lot better than, this guy over here's credit card was a little less expensive. Although we would like to have your credit card less expensive, it's just not quite as exciting for us.
Christy,
totally agree. In the Western world, it's more about convenience things. We want to make transactions easier. We want to bring people cheaper stock market transactions like FlatEx or E-Trade does. We want to do wealth management for them. It's a different stage where the clients are in. Like in emerging markets in Africa, yeah, you want to give them a basic account. You want to give them access to loans. And what I totally agree is the merge of mobile phones and financial services, especially in frontier and emerging markets, makes a lot of sense because and then if you take I just saw a similar company, I think, to yours, which, yeah, you have extremely high interest rates for retail, in frontier and emerging markets, because sometimes, for example, the banks don't even, the traditional ones don't even know who they lend the money. So they say, okay, I give you $100, I charge 100% a year, because they secretly hope he pays it back, then they make a lot of profit, but they lose a lot of clients just because they're not able to follow up credits. Yeah, so it's a very ancient thing. So if you now come as a technology company and provide them the possibility to rate clients, or first identify clients, then rate them, whatever, you bring interest rates dramatically down because you decrease risk. Yeah, so and if you look at those, look at Africa, again, in average, I would say these non-securitized consumer loans, like payroll lending, is like 100% a year, 200% a year, which really burdens the people. Yeah, if you bring that down by technology to 30% a year, 40% sounds high, but for them it's super low. Yeah, you really give that money, what they save, to the people. So there you have a real massive advance.
And the flip side of that too is, there are a lot of people retiring. They have their pensions. They need income, and you have to put money to work. And it's a low interest rate environment. How do you help people with their retirement? Well, the answer is you have hundreds of millions of people moving into the middle class who are trying to buy education and improve their life. We need to put trillions of dollars to work for the retirees in places like Japan and Germany. And the middle class in the emerging market is really our best hope for how do we successfully deploy that capital, because they're paying 100% interest rates. If somewhere between the 100% interest rate they're paying and the 3% interest that you could get for a bond here, there's a winning situation for everyone.
So clearly there's an aspect of bringing financial services to people who have had not access to it. There's also an element of innovating financial services for people who already have experienced them. So my question is, clearly there's opportunities for banks, there's opportunities for startups. But in this whole thing, say in the Western world, is the consumer going to be better off? Is the consumer going to be better off?
We just had the example, meaning in frontier markets.
No, but in the Western markets.
I would say absolutely. I think that some people are going to lose money because when you invest and when you try new things, you take risk. and there are some people who are going to lose money. But the ability to manage your finances while you're waiting for an elevator, or to have a better visibility into what your finances are and what's going on in real time, is going to allow people to feel more confident in what's going on and really have a more intimate relationship with their financial health. So I think consumers are the ultimate benefactor here.
I think also here we have to differentiate between developed countries and emerging countries. And I think it was rightly said that in emerging countries, it's basically a big chance of financial inclusion, to bring new people into the whole banking life cycle. And therefore, I don't see any, let's say, threat for the consumer to be let down, because these are mainly people that don't today not part of the overall electronic and internet life cycle. So here I just see a big opportunity. Of course, in the developed world, I also see, or I think that chances for the consumer, might it be on the cost side, also on the, let's say, the ability to really, in a much more ergonomic way, for example, over your smartphone, build your banking needs into your daily life cycle. So I think on this level, the chances and the opportunities for the consumer are much larger than, so to say, the risks. That somebody is losing money, yes, of course, always somebody can lose money. Also today, if you have been investing in, or if you had your money in some European banks or in some international banks, you have the possibility to lose your money. I don't see the big changes there. What perhaps, of course, is a new paradigm that the real-time data gathering also will be more intense when these are online and internet-driven processes. And of course, some consumers like that and have no problem with that, and some consumers perhaps would see that as a threat. This is why I think it must happen in a very transparent way, and it must happen in a way that the consumer really actively opts for a service and isn't forced or isn't disguised. And I think if this happens in that way, this can be a full win-win for the companies that are doing it, and as well as the consumer that is benefiting from these new services.
Correct. So we'll change tacks a bit. So let's talk a little bit about each of your own companies and how they have evolved. So Jeff, in your case, you started out life actually lending money yourself, right? And now you're a service provider providing information. Tell us a bit about what you learned and how you changed and why you changed the business model.
Sure. So we got into this business because we had started several companies. We had employees all over the world, and they kept coming to us asking for loans. And as their employer, we were like, why are they coming to us? They should go to a bank. But it turns out that the banks didn't know how to deal with them. So we had a theory that if we looked at their mobile social footprint of their phone and who they're connected to and how the community interacts with them, that we could predict who are the good borrowers. And we knew from our experience in big data that to build good algorithms, you had to actually have the data set, the training set for the machine learning. So we set up 3 lending companies, one in the Philippines, one in Mexico, one in Colombia. We issued thousands and thousands of loans, and that gave us the data to build the algorithms. What we were pleased to find is, A, it is highly predictive, and B, the algorithm is almost the same in every country. In fact, you could take the algorithm from the Philippines and you could administer credit in Mexico. So that gave us the confidence to then go to other financial institutions and say, would you like to use our algorithm? And sure enough, they did. What we also found was that they also had a problem with identity and fraud. And we were sending money to strangers. We had no problem because there's so much data in your digital footprint where we know that we're dealing with the person we think we're dealing with. So we broke that identity algorithm off as a separate product, a verification product. And now we have banks in Africa, in India, Indonesia, We're about to make a big announcement in another Asian country later this week. Every couple days, another bank comes online with using our algorithms to extend credit to new people.
Fantastic. So Markus, your business provides a lot of financial services to other innovative startup companies. Has that always been part of your business model, or is that something that evolved over the years?
No, this definitely evolved over the years. And I think we're a good benchmark generally for the development that fintech companies can take. We started with a technology-only process, connecting online merchants with banks, running their credit card, debit card business. So we connected the last line between a merchant and the banking, the different banking systems. Using internet as a gateway technology and implementing a virtual terminal on the merchant side. And then step by step, we extended our value chain. We heavily invested in the back end. We got a bank license ourselves. We set up our own acquiring service, acquiring processing, issuing processing service. And today we have a tuned back end that is fully focused on real-time internet technology. And we have innovative front ends where we go now also to the point of sale, to mobile, and where we cover today over internet-related payment processes, all sales channels. And we will never leave this core focus of payment. We invested probably in this backend hundreds of millions. And this is exactly what I recommend to new fintech startups. Concentrate, for example, on the front end and work together in your back end with companies also specialized on that. And this is what we do in payment. We do the full value chain, including the front end. And in other fintech services, for example, in retail banking fintech services, we provide our back end on a white label basis in terms of providing our risk management, our core banking service, etc., that new fintech startups very easily can go to the market. Or also retail banks that want to go in this area, and that's the strategy. So we have a clear core focus, but we develop the value chain over time, and this gives us today a big competitive advantage. And I think as a new startup, you have exactly to do that. You have to have a core focus, and then over time, develop your business model alongside the value chain, and perhaps broaden your value chain in terms of broadening the business model.
Fantastic. We are right on time. Thank you so much for sharing your insights about the disruption of the banking business. We very much enjoyed it, and thanks very much for your time.
Thank you.
Great, thank you.